Always a pleasure, Colin. Thank you for having me.
2017 seems to be off to a good start for resource investors. I want to ask, in terms of what's driving commodity prices up right now, are we beginning to see signs of inflation coming into play, or do you just perceive this as a change in the supply-demand outlook?
I have to admit, Colin, that I don't know. I still see weak global demand for almost everything, but there seems to be a sentiment change with regards to resources. I think partially this is warranted, partially this is not. An example would be the coal price, where the met coal price fell from circa $240 a ton to $70 a ton and has now rebounded to $160 a ton. I get that. The strength in the copper price, while it's certainly welcome, and while I believe it will go higher over the next 5 years, is really a mystery to me in the last 3 or 4 months, with the caveat, of course, that I'm a credit analyst, not an economist. It's welcome. I struggle to find a reason for it. Looking further down the road, Colin, 2 or 3 years from now, I get much higher commodity prices, as the prices that we currently are experiencing are not sufficient to incent the production or incent the capital allocations that would be replacing what we're producing. But the fact that we've had this little market in the last 6 months, I have to say, although it's welcome, is mystifying to me.
A lot of people have used the example of a baseball game and pointing to we're in the first inning, or I heard you last month, I think, refer to us being maybe even in the third inning of the game at this point. But you just said something very important, was that the price movement we've seen so far does not support new construction. It's not necessarily that important long term, and what that means is these stocks probably have a lot further to go if we are in a long-term bull market. Can you put that in perspective just from your past work on
yes,
what we
I'd
can
love
see?
To. The stocks can go a lot further, but bear in mind they can fall by 30 or 40% first. An example would be the uranium business. Colin, you know I'm a bull on the uranium business, but the stocks have increased by 50 or 100%, with the yellow cake going from a ludicrous level up to a disastrous level. I believe that uranium in the 5 to 6 year time frame will go from its current spot price, which is about $23, to a contract price of, say, $60, which I believe is the fully loaded cost of producing uranium on a global basis. Well, the $23 price that we see now is certainly an improvement over 19. It's an unmitigated disaster for the uranium business. And the fact that the uranium stocks are up by 50 or 100% is an absolute mystery to me. While I believe that many of them will be up 1,000% or 2,000% over 5 years, it wouldn't surprise me to see them fall 30 or 40% first. By the way, I'm not telling your audience to sell uranium stocks. What I'm telling your audience is that if you are participating in a game that has a 3 to 5 year end point, understand that you have to be prepared to take a lot of pain on the way to your game.
On the point of uranium, emails have flooded in since our last interview and since Sprott's participation in the GoviX financing, which, by the way, is up 150% since Sprott participated. But as Daniel Major has pointed out, GoviX is the 5th largest publicly listed holder of Yellowcake, and while that stock is up, its market cap certainly doesn't tell the story of being that big of a holder globally. What do you think is the story moving forward?
Well, I don't want to tell people to either buy or sell GoviX because I don't know very many people in your subscriber base individually. From my own viewpoint, my holdings in GoviX are ones where I realize that I will have to finance the company at least twice more, and I'm prepared to do that. They have enormous uranium holdings, and more importantly, the on-concession exploration potential of their uranium assets, I personally believe to be vast. GoVX doesn't have a deposit that would do anything other than lose a fortune at $23 uranium. So with GoVX, you're playing really four games. You are playing the uranium price increase game. You are playing a game that has to do with the normalization of politics and sociology in Africa. You are playing a very competent individual and team in the face of Govind Friedland. And you are talking about the ability of two different constituent financial organizations, the Lundin Group and the Friedland Group, to get behind this story in a major way if the market gives them an excuse. That's the good news. The bad news is if you own GoVX with the view that something is going to happen fundamentally in your favor in 2017, you're a misguided human being. You own GoVX because you know that at some point in time the uranium price is going higher, and you are gambling that their cost of capital will stay low enough that you can arbitrage both the uranium market and the politics of Africa. This is a game where if it works, you get to put a zero behind your holdings. In other words, you get a tenfold or 20-fold increase. It's also a game where if you get shaken out by a 50% price decline, which could happen, that the stock could go up 1,000 or 2,000%, but you could get left in the weeds because you got shaken out of the stock. If you don't have a 3-year horizon or you don't have a 5-year horizon, if you aren't prepared to absorb both boredom and pain, and when I say pain, I mean perhaps terror, a 50% price decline, don't own stocks like this.
Rick, on to gold stocks. Last time we had you on, you stated that historical analogs can paint many different pictures of what could be to come for gold stocks, and I'm talking about the positive divergence that's continued. Gold stocks have maintained strong against the price of gold, which has not been so strong in the second half of 2016. Does that tell you anything new at this point, or do you maintain the same sentiment?
I'm cautiously bullish about the gold stocks. I wish I could be an unrestrained optimist again like 2015, but I can't. I'm cautiously optimistic about the gold stocks. In the first instance, I'm optimistic about the gold price. I believe, and I should caveat this, I'm not an economist. I believe that we're in one of those periods where we are having a bit of a flight to safety. I believe that we're in a period where the US dollar does well, which is typically bad for gold stocks. And I believe that we're in a period where the interest rate's going up, which is typically bad for gold stocks. But I would remind your readers that in the latter half of 1975 and the first half of 2002, in similar circumstances, the US dollar increased and the gold price increased too. This circumstance occurs when the US dollar increases not because of a fundamental strength in the US economy, but rather because of the relative weakness of other economies, and the US enjoys flight capital. That will happen in 2017, I believe, as a consequence of problems in the European economic community that are greater than the problems in the United States. And while most of that money will flow into the US Treasury, some will flow into gold too. You will note that when, on a different note with regards to interest rates in gold, you will note that the US Fed, in a political move, tightened their interest rate by 25 basis points. But the market tightened or increased the interest rate on the US 10-year Treasury by 100 basis points or 1%. So the question becomes, aren't high interest rates traditionally bad for gold? It depends on why interest rates are high. If interest rates are high because savers are demanding more compensation for what they see as the inevitable destruction of the currency, then rising interest rates engender rising gold price because the increase is a function of a lack of faith in the underlying currency. When people say that the interest rate rises can't accompany the gold price increase, they have to explain away the decade of the 1970s, where interest rates rose fivefold, 10-year interest rates rose fivefold, and the gold price went from $35 an ounce to $850 an ounce. So in answer to the first part of your question, Colin, I am cautiously optimistic about the gold price. I'm also cautiously optimistic about gold equities. Starting at the top, I think that the catastrophic mistakes that the gold mining community made in the last decade, where the price of gold went from $250 an ounce to almost $2,000 an ounce, and free cash flow per share in the industry declined. I think those memories are so fresh in the investment community and so fresh in the minds of mining company managements that the mistakes that were made last decade won't be repeated for 2 or 3 years. The malinvestment, the misinvestment, the stupid takeovers, the stupid capital allocation decisions, I don't think will occur for 2 or 3 years. The consequence of that is that the benefit of $1,200 and then $1,300 and then $1,400 gold, rather than being wasted by stupid management decisions, will flow through to shareholders, which I think will be a good thing for the shares of the mining companies that are managed in a newly rational fashion. I think that the second tier gold mining companies who stick to their knitting will enjoy the same cash flow benefits, but I think there will be continued consolidation among second tier producers, either by the majors or lateral consolidations, because one thing the industry needs is to lower the level of general and administrative spending relative to both capital expenditures and relative to revenue. And I think that that will happen, which I think will be good for the equities. And finally, I think that there has been a dearth of exploration in the gold mining industry, both in terms of the dollars spent and the quality of the spending that has taken place. And what that means is that high quality gold discoveries will get taken out at eye-popping premiums. So in summary, with regards to the gold equities, I'm cautiously optimistic. I'm optimistic about the gold price. I'm optimistic about capital allocation decisions. And I'm optimistic about the prices that will be paid for high-quality assets, which are scarce.
Rick, industrial commodities were the surprise of 2016. Most resource investors were expecting the precious metals complex to move, but not necessarily to witness a broad resource bull market. Therefore, I want to ask, are you bullish on these industrial commodities, or on the contrary, are you worried they could come right back down to where they started?
I'm bearish for 2017. I'm incredibly bullish for 2019 and 2020. It's a function of perspective. I think we've seen the commodities and the commodities equities move too far, too fast. I hope I'm wrong about the status of the global economy. I would love to see the global economy shake off the impact of idiotic governments on the left and the right and begin to approve of its own volition, which would see commodity prices lower. I don't see that in the cards. So my own suspicion is that the increase in commodities prices that we've seen will either moderate or cease. As I say, I would love to be wrong, and I'm really bullish about the commodities, many of the commodities. Maybe not steam coal, maybe not iron ore in the 2019-2020 timeframe, but I'm much less optimistic about those commodity prices in 2017.
And final question for you. If you had to guess a handful of commodities that you would look at for 2017, maybe oddball commodities that could really outperform and surprise investors, do you have your eye on any?
I really don't. I have my eye on some companies, but by now, Colin, you have so many listeners that I'm not going to tip my competition as to what I what I would like to do. In terms of commodities, I think the commodities and the commodities equities that will likely perform the best for 2017 are probably precious metals related.
Palisade's not a brokerage house, and we don't manage investors' money, but Sprott does. And I have a lot of people that contact me, Rick, that are looking to participate in private placements and are U.S. investors, and I have absolutely nobody to send them to except Sprott. If you can just give a little bit of information on how people can reach out if they're U.S. people looking to invest money in private placements.
Well, we would be, of course, delighted to entertain discussions with people who are interested in private placement or, in fact, general market investing. We are happy to take investors from any corner of the earth, although we're happiest to take American and Canadian investors. You can find us by going to our website, www.sprottglobal.com, or you can call us at 800-477 7853. We would love to have those discussions.
Rick, thanks for coming on as always.
Always a pleasure, Colin. Thank you for having me on. Think you understand the junior mining sector, and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
How violent that term could be, it actually could be quite violent. It could be a rip-your-face-off uranium rally.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen? Or are you too stupid?